Hey everyone, and welcome back for another deep dive.
Yeah.
Today we're going to be traveling back in time to 1970,
Ooh,
using The Intelligent Investor by Benjamin Graham as our guide.
a classic.
Yeah, and we're going to be looking at four companies that were listed on the New York Stock Exchange back then
Okay.
to see what made them tick and whether Graham's, classic investing principles can
Yeah.
still teach us something today.
Yeah, what's really interesting is we're going to be looking at companies that had pretty similar performance,
Mm-hmm.
but wildly different valuations.
Oh, really?
Yeah, it's like a puzzle, you
Yeah.
know?
Yeah.
Why were some companies trading at bargain prices
Right.
while others were,
The hot ticket item.
yeah, the market darlings that everyone wanted a piece of?
Yeah, like finding hidden gems versus going for the obvious crowd pleasers.
Exactly.
So who are our contenders in this 1970s showdown?
Okay, so we've got LTRA Corporation,
Right.
which was formed from a merger of companies in the automotive and printing industries. Then there's Emerson Electric,
Okay.
a name you probably recognize making all sorts of electric and electronic products.
Yeah.
Next up is Emery Air Freight,
Okay.
specializing in, you guessed it, air freight.
Makes sense.
And finally, we have Emhart Corporation, which started in bottling machinery but was branching out into hardware.
So only one of these companies still exists in its original form today,
That's right.
and that's Emerson Electric.
Yep.
LTRA went through more mergers and is now part of Honeywell.
Wow.
Emery Air Freight is part of C&F Inc. And Emhart was scooped up by Black & Decker back in 1989.
Okay.
So we'll be looking at their past performance through Graham's lens
Right.
and see how things actually played out for them in the long run.
Yeah, that's going to be really interesting to see how those two things compare.
Yeah.
What's really fascinating is that all four companies had decent performance,
Okay.
but their price-to-earnings ratios were all over the map.
Mm.
Eltra's P ratio was a very modest 9.7. Emhart was at 12, then Emerson jumps up to 33, and Emery tops the chart at a whopping 45.
Whoa, that is a wide spread. To put that in context, the Dow Jones Industrial Average at the time had a PE of 15.5.
Right.
So some of these companies were way above and some way below the average.
Yeah.
So how do we make sense of this discrepancy?
Well, that's where Graham's 6 key performance factors come in.
Okay.
He digs deeper than just the PE ratio, looking at profitability, stability, growth, financial position, dividends, and price history.
So like a full checkup on the company rather than just glancing at its temperature.
Exactly.
I like that.
Yeah.
Okay, so let's break down those factors one by one.
Okay.
Starting with profitability, how did our four companies stack up?
All four showed a good return on book value,
Yeah.
which basically means they were making a decent profit on the money invested in the business.
Gotcha.
But Emerson and Emery really stood out.
Okay.
Emery, in particular, had exceptionally high returns in both 1961 and 1969.
So they were the profit powerhouses of the bunch.
You could say that.
All right, what about stability?
Okay.
Were they consistently profitable or did their earnings bounce around a lot?
Emerson and Emery aced this category too, showing 100% stability.
Wow.
This means their earnings didn't decline at all during the period we're looking at. LTRA and Emhart had some dips, but nothing too dramatic,
Okay.
comparable to the Dow's performance at the time.
So even though LTRA and Emhart had those lower PE ratios, their earnings weren't wildly fluctuating. Nope. They were holding steady.
Yeah.
That's good to know.
Yeah.
Now, how about growth?
Okay.
Were these companies expanding and increasing their earnings?
Even the so-called cheap companies, LTRA and Emhart,
Right.
were growing at a good clip, surpassing the Dow Jones average.
Mm.
But of course, Emerson and Emery were the real stars in this department, with their already high earnings growing at an even faster pace.
It sounds like they were riding a wave of success.
Yeah, they were doing really well.
But high growth often comes with higher risk, right?
That's true.
What about their financial position?
Okay.
Were they on solid ground or were there any red flags?
This is where we see the importance of looking beyond the flashy numbers.
Okay.
All four companies had solid financials overall.
Okay, that's good.
The manufacturing companies,
Yeah.
LTRA, Emerson, and Emhart, had what we call a great current asset to liability ratio.
Okay, hold on a sec. For those of us who aren't financial whizzes, can you explain what that ratio means and why it matters?
Of course. Think of it like a financial safety net.
Okay.
A high current asset to liability ratio means the company has more assets that can quickly be turned into cash, like inventory or money they're owed readily available to cover its short-term debts.
Okay.
This makes it less vulnerable to financial shocks, kind of like having a cushion to fall back on.
That makes sense.
Yeah.
So the manufacturers At a strong safety net.
They did.
But what about Emery Air Freight?
Right.
They weren't in manufacturing.
Good point.
Yeah.
Emery, being in a different industry, had a lower current asset to liability ratio, but still a strong track record.
Okay.
The key takeaway here is that none of them were overloaded with debt, which is always a good sign.
That's reassuring.
It is.
So they were profitable, stable, growing A&D, financially sound.
Yeah.
Sounds like a recipe for success.
Yeah.
What else did Graham consider?
He looked at their dividend history,
Yeah.
which is basically how much profit they were sharing with their shareholders.
Right.
And this is where we see some interesting contrasts.
Okay.
Emhart is the champion here with an unbroken streak of dividend payments since 1902.
Wow.
Talk about reliability.
That's impressive.
It is.
Yeah.
LTRA had a good record, too.
Okay.
Emerson was decent, and Emery was relatively new to the dividend game.
It's fascinating how the dividend yields sort of mirror those price-to-earnings ratios. The cheap companies had higher yields, meaning they were paying out a bigger chunk of their profits as dividends. And the dear companies had lower yields because investors were betting on their future growth rather than immediate income.
Exactly. It shows how investors were valuing these companies back then.
Yeah.
Those seeking income might be drawn to Eltra and Emhart,
Right.
while those focused on growth potential might favor Emerson and Emery.
So we've covered profitability, stability, growth, financial soundness, and dividends.
We have
What's the last piece of the puzzle?
price history. And this is where things get really interesting.
Ooh, okay.
All four companies had seen incredible price increases over the past 3 decades, way more dramatic than the Dow Jones average.
Wow.
We're talking a range from a 17-to-1 ratio for Emhart,
Okay.
meaning its highest price was 17 times its lowest price,
Oh,
to a mind-boggling 528-to-1 ratio for Emery Air Freight.
528 to 1. That's almost hard to comprehend.
It is pretty wild.
Yeah. So while these companies had great track records,
Yeah.
the stock prices had also been on a roller coaster ride.
Exactly.
Yeah.
And this is where Graham's cautionary note comes in. He emphasizes that past performance doesn't guarantee future returns.
Right.
Just because a company's stock has gone up a lot in the past doesn't mean it will continue to do so.
It's a reminder that the market is always changing and there are always risks involved.
For sure.
So we've laid the groundwork looking at all these factors for each company.
Yes.
Now comes the exciting part. What did Graham actually think about each company?
Let's dive into that.
All right. We're back and ready to hear Graham's verdict on these 4 companies.
Okay.
We've got LTRA and Emhart,
Right.
the solid, but maybe less exciting contenders.
Yeah.
And then Emerson and Emery, the high-growth stars.
Right.
Where do we begin?
Well, let's start with Emerson Electric.
Okay.
Graham called it a goodwill giant,
Oh, okay.
which means a lot of its value was based on its reputation and future potential rather than just its tangible assets.
Okay.
It was a popular company with a high valuation,
Right.
but Graham saw some potential warning signs.
Kind of like a celebrity stock.
Mm-hmm.
Everyone knows them. They've got a great track record.
Yeah.
But maybe their price is inflated because of all the hype.
Exactly. And this is where Graham's value investing approach shines.
Okay.
He was wary of companies with sky-high valuations because they have further to fall if things go wrong.
Right.
He drew a parallel to Zenith Radio,
Okay.
another company that was a market darling, but then experienced a huge decline.
Oof.
It's a reminder that what goes up can also come down,
Right.
especially when expectations are running high.
So Emerson was the hot stock,
Yeah.
but Graham was urging caution.
Right.
What about Emery Air Freight?
Okay.
They were the fastest growing of the bunch.
Yes.
But you mentioned earlier that Graham questioned whether that growth was sustainable.
Right. Their growth was impressive.
Yeah.
But they were starting from a smaller base.
Okay.
Imagine a small company doubling its revenue. That's a huge percentage increase, but the actual dollar amount might not be that big. As a company gets larger, it becomes harder to maintain those high growth rates.
It's like trying to push a snowball uphill.
Aha, yeah.
At first, it's easy to make it grow quickly,
Right.
but as it gets bigger,
Yeah.
it takes more and more effort.
Exactly.
So what did Graham think about Emery's prospects?
He didn't dismiss them entirely,
Okay.
but he pointed out some potential vulnerabilities.
Okay, like what?
Well, competition in the air freight industry was heating up,
Okay.
and there were always regulatory changes to worry about.
Mm.
He said a lot more research would be needed to make a sound judgment.
So a proceed with caution label on Emery?
Yeah, pretty much.
What about Eltra and Emhart?
Okay.
They were the solid performers with less hype.
Right.
What was Graham's take on them?
He saw them as potentially undervalued.
Really?
Yeah, they had good businesses, strong financials,
Right.
and a history of paying dividends.
Okay.
But they lacked that market darling appeal. To give you a sense of their future prospects, he quoted Standard & Poor's assessments from 1971.
Okay.
For LTRA, they highlighted their diversified operations as a plus,
Okay.
meaning they weren't overly reliant on any one industry.
Makes sense.
And for Emhart, they expected an earnings rebound
Okay.
and considered the shares worth holding.
So even back then, analysts were weighing in on companies just like they do today.
Oh, yeah, definitely.
It's interesting to see how their assessments aligned with Graham's own analysis.
Right.
It seems like he appreciated a company with a diversified portfolio, spreading risk across different industries.
Yeah,
That makes sense. Kind of like not putting all your eggs in one basket.
precisely. And this brings us to the heart of Graham's investing philosophy,
Yeah.
the idea of being a defensive investor.
Okay, time for another quick definition check.
Sure.
What exactly does it mean to be a defensive investor?
Okay.
Is it like hiding out in a bunker waiting for the market to crash?
Not quite.
Well.
A defensive investor is someone who prioritizes safety and stability over trying to hit it big with risky bets.
Right.
They're looking for solid, well-established companies with a proven track record.
Okay.
And they're willing to be patient,
Yeah.
letting their investments grow steadily over time.
So it's more like building a strong foundation for your portfolio.
Yeah,
Rather than trying to time the market
right.
or chase the latest hot stock.
Exactly. And Graham laid out 7 specific criteria for identifying companies that fit this defensive investor profile.
Okay, what are they?
Well, these include adequate company size,
Uh,
a strong financial condition,
okay.
a long history of dividend payments,
Right.
consistent earnings,
Makes sense.
reasonable growth,
Okay.
and a stock price that doesn't exceed certain multiples of assets and earnings.
Gotcha.
He was really looking for companies with strong fundamentals
Yeah.
and a margin of safety.
It sounds like he was trying to minimize risk while still aiming for decent returns.
Yeah, that's a good way to put it.
So, looking back at our 4 companies,
Yeah.
would any of them fit the bill as a defensive investment?
Well, LTRA and Emhart would likely be more appealing to a defensive investor.
You okay?
They had those solid fundamentals
Right.
and weren't as overvalued as Emerson and Emery.
So would Graham say that growth-focused investors should just steer clear of those dear companies altogether?
He wouldn't necessarily say that.
Okay.
He acknowledged that high-growth companies can be attractive,
Right, yeah.
especially if you have a higher risk tolerance.
Yeah.
But he cautioned that you need to be extra careful when evaluating them.
Okay.
You need to make sure that their growth is sustainable and that their price isn't inflated by hype or speculation.
Right. So we've seen how Graham approached these companies back in 1970.
Yeah.
Now let's shift gears and see how these principles can help us evaluate companies in today's market.
Okay.
The world has changed so much.
For sure.
The industries have evolved. Technology is a much bigger factor. Do these ideas still hold up?
That's what's so remarkable about Graham's work.
Okay.
The specific companies might change,
Yeah.
the markets might fluctuate, but the underlying principles of intelligent investing remain relevant. It's about looking beyond the hype and focusing on the fundamentals of a business.
So how would we apply Graham's 6 factors to a company today?
Okay.
Let's take profitability, for example.
Right.
We'd still look at metrics like return on equity and operating margins, right?
Absolutely. Those are core indicators of a company's efficiency and ability to generate profits.
Right.
But we might also consider additional metrics that are relevant in today's business environment,
Okay.
like gross margin, which tells us how much profit a company makes on each dollar of revenue after accounting for the cost of goods sold.
Okay.
This can be particularly important in industries with high competition and tight margins.
Okay, so we're refining the toolkit, but the core idea of assessing profitability is still there.
Exactly.
What about stability? Would we still focus on earnings fluctuations over the past decade?
We'd certainly consider that.
Okay.
But we might also want to look at other factors that could impact a company's stability in today's dynamic world.
Like what?
For example, how reliant is the company on a single product or market?
Right.
How exposed are they to regulatory changes?
Okay.
What's the competitive landscape like?
Yeah.
These are all things that can make a company more or less vulnerable to disruptions.
So it's about understanding the broader context in which a company operates.
Yeah.
And assessing its ability to weather storms.
Yes, exactly.
What about growth?
Okay.
A high growth rate is still attractive,
Sure.
but we need to be even more discerning about its sustainability, right?
Absolutely. In today's fast-paced world, especially in the tech sector,
Uh-huh.
growth can be explosive but also fleeting.
Right.
We need to look beyond the top-line growth rate and ask ourselves,
Okay.
what's driving this growth?
Right.
Is it genuine innovation?
Ah.
Is it expansion into new markets? Or is it something more temporary,
No.
like a one-time boost from a new product launch or favorable market conditions?
Right. We need to separate the signal from the noise and figure out if this growth is built on a solid foundation.
Exactly.
What about financial position?
Okay.
Are there any new wrinkles we need to consider when analyzing a company's balance sheet today?
We'd still scrutinize a company's debt levels, cash flow, and overall liquidity,
Yeah.
just like Graham did.
Okay.
But we might also delve deeper into the nature of its debt.
Oh, okay.
What are the interest rates?
Okay.
When are the loans due?
Right.
What kind of covenants are attached to them? These details can give us a better understanding of the company's financial flexibility and its ability to handle its debt obligations.
So it's not just about how much debt a company has,
Right.
but also about the terms of that debt and how it's structured.
Exactly.
What about dividends?
Okay.
Are they still a relevant factor in today's market,
Hmm.
where muddy companies,
Uh-huh.
especially in the tech sector,
Right.
choose to reinvest their profits for growth rather than pay dividends?
Dividends can still be a valuable signal,
Okay.
but we need to be more nuanced in our assessment.
Right.
While a long history of dividend payments can indicate financial strength and shareholder friendliness,
Right.
it's important to consider the payout ratio,
Mm-hmm.
which is the percentage of earnings paid out as dividends.
Okay.
A high payout ratio might suggest that a company is struggling to find profitable ways to reinvest its earnings for future growth.
So dividends are good, but too much of a good thing could be a red flag.
Yeah, it's all about finding that balance.
It's all about finding that balance.
Right.
And finally, we come to price history.
Okay.
Graham looked at historical price movements for context.
Uh-huh.
But you mentioned earlier that past performance is not always a reliable indicator of future results.
Yeah, that's true.
So how do we evaluate a company's price in today's market,
Mm.
where sentiment can shift rapidly and algorithms drive a lot of trading activity?
That's a great question. And it gets to the heart of what Graham called intrinsic value.
Oh.
It's about figuring out what a business is truly worth,
Right.
independent of all the market noise and fluctuations. This involves analyzing a company's assets, its earnings potential, its growth prospects, and its competitive position to arrive at a reasoned estimate of its underlying value.
It sounds like a lot of work.
Yeah.
Is it even possible to do this accurately in today's complex and rapidly changing market?
It's certainly challenging,
Yeah.
but it's the essence of value investing.
Yeah.
It's about separating the signal from the noise, focusing on the fundamentals, and being patient. It's about resisting the urge to chase the latest hot stock and instead looking for companies that are undervalued by the market.
So we've covered a lot of ground here, adapting Graham's principles to the modern market.
We have.
But what about his 7 statistical requirements for defensive investors?
Okay.
Do those still hold up?
They're a fantastic starting point,
Okay.
but we might need to adjust them slightly for today's market.
Okay, how so?
For instance, the size requirement might need to be tweaked.
Okay.
Companies tend to be much larger today than they were in Graham's time.
Right.
So we might need to raise the bar a bit.
And what about the requirement that a stock price shouldn't exceed certain multiples of assets and earnings?
Right.
Those multiples might need to be adjusted as well, right?
Absolutely. Interest rates were much higher in Graham's era,
Uh-huh.
which impacted those valuation multiples.
Okay.
In today's low interest rate environment,
Right.
we might need to use different benchmarks.
So it's about understanding the spirit of those requirements and adapting them to the current market realities.
Exactly. That's the beauty of Graham's approach.
Okay.
It's not a rigid set of rules,
Sure.
but a framework for thinking critically about investments.
Okay, so we've seen how Graham's ideas can be applied in a modern context.
Right.
But let's get back to our 1970s deep dive.
Okay.
If we were transported back to that time, armed with all this knowledge, would we have been able to pick the winners and avoid the losers?
Ooh, that's a good question.
Yeah, would we have been tempted by those high-flying stocks?
Right.
Or would we have stuck to Graham's principles and gone for the less glamorous but perhaps more undervalued options?
That's a tough one.
That's a tough one.
It is. It really is.
We've been on quite a journey today exploring Benjamin Graham's investment wisdom through the lens of these four companies from 1970.
Yeah, it's been really interesting.
It's fascinating to see how his principles, developed decades ago,
Right.
can still guide us in today's market.
Yeah, they're surprisingly relevant.
Exactly. But let's be honest, if we were actually back in 1970,
Yeah.
faced with those four companies,
Uh-huh.
would we have had the discipline to follow Graham's approach?
Ooh.
Those high-growth companies,
All right.
Emerson and Emery,
Yeah.
they were tempting.
They were really tempting, especially with all the hype surrounding them.
It's easy to say now,
Yeah.
knowing how things played out,
Uh-huh.
that we would have made the rational choice.
Right.
But in the moment,
Yeah.
surrounded by all the market noise,
Right.
and perhaps even pressure from others to jump on the bandwagon,
Yeah, definitely.
might have been a different story.
It's so easy to get caught up in the excitement
Yeah.
and think that the good times will just keep rolling.
That's why Graham's emphasis on having a sound investment philosophy
Mm-hmm.
and sticking to it,
Right.
even when it's tempting to stray,
Yeah.
is so crucial.
It's like having a plan and actually following it even when things get tough.
Yeah.
It's easier said than done, but it's so important.
It's like having a compass to guide you through the ups and downs of the market.
Exactly. A very good analogy.
So as we wrap up this deep dive into Graham's world,
Okay.
what are the key takeaways for our listeners who are navigating today's market?
Well, I think the most important lesson is to remember that investing is not a get-rich-quick scheme.
Right.
It's about building wealth gradually and steadily over time by focusing on companies with solid fundamentals and a track record of profitability.
And it's about being patient.
Yes.
Patience is key.
The market can be irrational in the short term,
Absolutely.
but in the long run, quality companies tend to prevail.
That's what we hope for anyway.
Yeah, exactly. And don't forget the importance of diversification.
Oh, yeah, that's huge.
Don't put all your eggs in one basket.
Spread the risk.
Spread your investments across different industries and asset classes to reduce your overall risk.
Very good advice.
And finally, always remember to do your own research.
Yeah, don't just follow the herd.
Don't just rely on headlines or what others are saying.
Right.
Dig deeper. Understand the business.
Yes.
And make informed decisions that align with your own investment goals and risk tolerance.
That's the essence of being an intelligent investor, as Graham envisioned it.
Well said. Thanks for joining me on this fascinating deep dive into the world of Benjamin Graham.
It's been a pleasure. We hope you've learned some valuable insights that you can apply to your own investment journey.
I hope so too.
And to our listeners, we'd love to hear your thoughts.
Yeah, let us know what you think.
Which of Graham's principles resonated most with you?
Right.
How do you think his approach can be adapted to today's market?
That's a great question to ponder.
Share your insights and join the conversation on social media.
We love to hear from you.
Until next time, happy investing.